As of today, there's over 8,000 exchange-traded funds in the world. Within that number, there's hundreds, if not thousands, that track different indexes and are classed as index funds. If we were to look at the wider market and include mutual fund, that number could easily double or triple. So with so many on offer, how in the world do you just pick one? Do you want one that tracks specific markets like the USA, the UK, Europe, or perhaps emerging markets? Or do you want to go more specific and pick interesting ones like AI funds, clean energy, or maybe tech? It's no wonder that the decision to choose one is so complicated. The problem usually includes having multiple funds that overlap, or owning them just because they like the sound of them. But what if you want to buy just one fund? Well, I think now we have a very good answer to that question. There's ETF out by Invesco, and it's proving to be a very popular option, and its fees are competitive. And I'm proud to say that Invesco have been kind enough to sponsor today's video. For me, it's so great when something fits so seamlessly that I'm actually using, and we can support what we're doing here. So let's talk about why you might want to consider this fund as an all-in-one ETF going forward. The most important thing to realize is why you want to pick a fund in the first place. And the clear answer is that equities have outperformed other types of investments in the long run. If you would have had £10,000 invested in the global equity markets 20 years ago, your investment could be worth more than £71,000 today. That's more than 3 times what you would have had from investing in bonds, 4 times as much from investing in commodities such as gold, or more than 5 times as much if you'd held your money in cash. While past performance isn't necessarily an indicator of how things will move going forward, this chart demonstrates how much you've expected from each based on investing £10,000 over 5, 10, 15 and 20 years. We can see there's a huge difference between 20 years in cash and 20 years in the stock market. And when we look at the return for each type of asset by year, although cash has never particularly gone down, the returns are also not very good. Even when you see equities have gone down, missing out on those other plus 10 and plus 20% years more than makes up for it. You would expect an average of anywhere from 5 to 8% per year over a long enough period of time. These numbers come from comparing it to an index like the FTSE All-World Index. But an index is not an investment product. That's why we need a fund that aims to track that index as closely as possible. But it's important to understand that investing in equities isn't like keeping your money in a savings account at the bank. There's no guarantees, and they can go down as well as up, especially over shorter periods of time. But equally, we know that just leaving money in the bank doesn't beat inflation, and over a longer period of time, investing in the stock market gives you a better chance of beating inflation than leaving cash in the bank. The problem is, to most people, the idea of getting a better return than the banks sounds fantastic. But the idea of investing in stocks is super scary, and they feel like they need to be financial gurus to beat the market. In fact, when I tell people I help people learn how to invest, they think I'm picking the next stock to explode overnight. Jokes aside, it's far easier than you would think. We don't actually need to pick individual stocks. This is where diversification comes in. If we can diversify when we invest, we spread our eggs instead of putting them all in one basket. If you invest in just one stock, it could become an overnight success, or it could more likely just turn out to be a failure. By diversifying, you're able to buy a range of different companies with just one. That way, if one of the 1,000 of stocks goes down, another will go up, so they could average out and give us a much steadier return. This works so well because over longer periods of time, the stock market and the collective value of the companies you hold get larger and larger over time. What this also allows is you to invest across a range of different countries. It's difficult enough to keep up what's going on with your own country's politics and economic outlook, never mind thinking about those different countries too. And when a local economy is slowing down, countries halfway across the globe could be experiencing rapid growth. If you were able to invest in a wide range of companies from both developed and emerging markets, you could have exposure to benefit from both. And in a similar way to stocks, if one may be doing poorly, another may be doing better. So the idea is you split your risk and not put all of your eggs in just one basket, aiming for an average return. You could look at doing something similar to what I've done in my portfolio, owning a separate fund for developed market countries and another for the emerging market countries. The downside is the way I do it is you have to be aware of rebalancing your portfolio as you go. I use my tool within Invest Engine to do this for me, but you could just buy one fund instead that covers you for both, and you might find that much simpler. Now, before we continue, you need to understand this. In this case, we want to make sure we're looking at an ETF rather than a mutual fund. This is confusing because on some platforms you'll find it quite hard to know the difference. Mutual funds are diversified collective investments. They can be both actively managed by a fund manager or they can be passively managed. Typically, actively managed funds will have higher fees, and there's trading costs involved in buying and selling funds, which is done once per day. A lot of fees around mutual funds can also be uncapped. Some could charge as much as 1% or more to look after your fund. An ETF, on the other hand, is trading on the stock market more like an individual stock, and they usually have lower costs than traditionally actively managed funds with lower trading costs. If you use InvestEngine like I do, they only have exchange traded funds, so you don't need to worry about accidentally picking a mutual fund. In my opinion, I prefer passively managed ETFs as they often have lower fees and they're easily accessible on platforms like InvestEngine. They're designed to track the performance of an index as cost effectively as possible minus fees. There's no manager making expensive investment decisions and trying to outperform the market. It simply does what it says on the tin. It tracks the performance as closely as possible. Now bear with me, there's also a difference between physical and synthetic ETFs. A physical ETF seeks to track the index by buying and holding a portfolio of securities that closely matches the index composition minus fees. Whenever the index changes, the ETF will need to buy or sell the securities so it continues to resemble it. A synthetic ETF also buys and holds companies, but they won't necessarily be the same as those in the index. So how can ETFs deliver the return of an index without buying and holding the same securities? The ETF enters into a financial contract with the bank, who agrees to swap the exact return of the index for the performance returns of the securities the ETF holds. In the end, the difference will be very minimal to you, but it's important you know the difference. So we know we're looking for a passively managed exchange traded fund which is diverse across a range of countries, sectors and markets with low cost fees. This is where Invesco comes in. Now some of you may have heard of Invesco and some of you may have not. Invesco is a leading independent global investment firm with over 8,400 employees in over 26 countries. They have funds across both active and passive investments to suit different needs. Some are equities, some fixed income, and some alternative investments like real estate and private credit. Invesco has trillions of assets under management. Yep, trillions, which could give people confidence that they are working with a partner of size, scale, and stability. They're currently the fourth largest ETF provider globally. So why should you pick the Invesco ETFs? Well, in general, they have some of the lowest cost ETFs on the market, and they have experienced some of the strongest growth in the company's history, doubling their market share. They have hundreds of ETFs globally with over 130 dedicated ETF investment professionals around the world with over 752 billion in their ETFs. I say this because I want you to understand they are huge, a big name, trusted investment provider. But there's an even more important reason you need to know. They launched their Invesco FTSE All World ETF. This offers a one-stop solution for investors who want broad market exposure. This ETF provides exposure to 4,000 companies across nearly 50 developed and emerging markets. The best thing about it though is it's now one of the cheapest on the markets. While there's no guarantees about the future performance of the stock market, the impact on fees of an ETF is easier to see. The cost of an ETF is a percentage dedicated from the ETF to cover the costs of running the fund. If we look at this chart, we can see the impact on fees of investing £10,000 using the actual performance of the FTSE All World Index over the past 20 years, and hypothetical returns of ETFs tracking the index, assuming different levels of fees. This is simply meant to illustrate the point, showing the ETFs with annual fees of 1%, 0.5%, 0.22%, and 0.15%. The fee is an annual percentage deducted daily on a pro rata basis. That means that the impact is often negligible over shorter periods of time, but over the longer term, even a small difference in the fee can make a big difference to the overall performance of your investment. This chart is a hypothetical example for the purposes of illustrating a point. It shows an investment of £10,000 invested over a 20-year period, with different fee rates applied. For example, a 1% annual fee reduced the final investment pot by almost £13,000, while a 0.15% fee reduced it by only £2,100, which is a huge saving. Investors in the FTSE All World Fund don't have to worry about adjusting allocations because it's automatically done by the ETF whenever the index rebalances. This can keep costs down compared to the typical costs incurred if you did it yourself. Other options in the space have fees of around 0.22%, so by Invesco coming in at 0.15%, it's one of the most cost-effective ETFs on the market currently for worldwide equity exposure. And in terms of what's within the fund, it's very similar. You've got exposure to a range of different sectors from IT, financials, consumer and healthcare, as well as exposure to different countries with, as you'd expect, America being the largest. Other is the second largest, so it's very diverse, followed by your countries including things like Japan, and we've even got some UK in there. The largest holdings are also what you would expect, big giants like Apple, Microsoft and Amazon among others. I think this fund is really good to see, and it's nice to see more competitive choices within the ETF landscape. Personally, when I move my pension into Invest Engine, this is an ETF I will be considering. The idea of having it all in one place and the emerging markets mixed in is very appealing. It also saves a hassle of trying to rebalance your funds. Investing in a lower cost ETFs and saving yourself 0.07 or 0.08% per year could make a big difference over time. Take a look using a fee calculator, it's surprising how much those can add up. Let me know what you think of this fund in the comments and if you are using it. I think it's super interesting and it seems to be increasing in popularity. I do think this could be a really popular option to consider going forwards. If you haven't seen my latest portfolio update, you can check it out right here and make sure you subscribe, and I'll make sure to let you know when and if I do make a switch to this fund. Thanks for watching, and I'll catch you over there.